The simplest activities are sometimes the most satisfying. The charm of lounging around friends or loved ones, socializing over delicious, freshly brewed coffee, laughing and reminiscing while you know you have all the time in the world. And as soft, relaxing music provides a warm soundtrack to the experience, you have a sense of renewal. Or maybe the bustling activity around you is the perfect ambiance to focus on your writing or Photoshop editing. Such a place was a catalyst for one of the great all-American business success stories. And now it's a relic. Welcome to The Quality Investor. Starbucks, the ubiquitous coffee house on seemingly every corner in America and growing worldwide. Starbucks' beginning, however, is a bit humbler. Initially founded as a purveyor of freshly roasted coffee beans, teas, and spices in 1971. They were coffee roasters first and foremost. That all changed in the early 1980s. Howard Schultz was the director of retail operations for Starbucks and was on a buying trip to Italy, and the old world charm of Milan and the espresso bar coffee culture captivated Howard. He came back to Seattle with a zeal to bring the Italian dolce vita and espresso to America. While having marginal success piloting the cafe concept at the now iconic Pike Place location, the ownership of Starbucks decided to scrap the idea. They noted the high cost of maintenance for espresso machines as well as Americans' unfamiliarity with the beverage. Howard then ventured out on his own in 1985, eventually raising $400,000 from investors, including Starbucks, to open his first store in 1986. The coffee house was called Il Giornale, after the Milanese newspaper and located in Seattle's Columbia Center. It also sold Starbucks roasted coffees. The location served as a laboratory for Schultz to experiment with his vision. Opera music played, paninis were served, and the baristas wore bow ties. Most importantly, his first barista, Jennifer Ames Karaman, helped create an array of espresso-based specialty drinks Starbucks then pioneered for Americans. In 1988, the original Starbucks owners wanted to sell. Schultz had a fight to buy Starbucks, however. An investor in Il Giornale, Sam Strom, wanted to make his own run at the purchase. Schultz's dream was almost lost until a lawyer friend of his recommended an unlikely mentor to help Schultz navigate the competition. This mentor was none other than Bill Gates Sr. Yes, Bill Gates Sr., father of Microsoft visionary Bill Gates. Schultz won the bid for Starbucks at a cool $3.8 million. He rebranded Il Giornale to Starbucks, and expansion began in earnest. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Howard Schultz wanted Starbucks to be a third place for consumers after home and work. He wanted to reinvent a commodity, coffee. Quoting Schultz, "We would take something old and tired and common, coffee, and weave a sense of mystique and charm that had swirled around coffee throughout centuries. We would enchant customers with an atmosphere of sophistication and style and knowledge," end quote. And that to me is the core offering of Starbucks, not a beverage, but an experience. That is the intrinsic value of the business, its essence, its economic moat. That experience allowed Starbucks to IPO in 1992 when they had 165 stores. Revenue had grown from $1.3 million in 1987 to $73.5 million at the IPO. The IPO raised $271 million for Starbucks. Starbucks' differentiator in the market was not just about quality of coffee, but about quality of experience. The company spurred what is known as the second wave of coffee. Coffee was already a consumer staple, but Starbucks helped usher in the cultural significance of the coffee shop lifestyle. This reached its cultural peak on popular 1990s sitcoms like Friends and Frasier. It wasn't about getting the caffeine fix on the way to work anymore. It became about the specialty drink, expertly prepared in a relaxing ambiance. Add in the socializing component, and we have the second wave of coffee. This is what enables Starbucks to generate seemingly exponential growth in the 90s and 2000s, and generating outsized returns for investors. They had a knack for interior design and creating a warm, inviting atmosphere where customers wanted to spend their time. This was Starbucks' niche, their economic moat. It was what they had in a commodity market that other places were scrambling to copy. Starbucks has another advantage as well. They were first movers in this space, beating the likes of Apple and Google. That is their payment app, which administers their loyalty program. While the loyalty program was created in 2009, the app launched in 2011. By 2013, Starbucks was responsible for 90% of all mobile payments in the US. It is also a growing share of transactions within Starbucks. 31% of total transactions at US company-operated stores were made via the app compared to 25% 2 years ago. While Starbucks views this as a way to capture additional on-the-go customers, there is potentially some money being left on the table. Part of the payment app includes a stored value option. This is where consumers can preload their account with cash and use it to pay later. Starbucks is acting as a de facto bank in this scenario. Now, this stored value is recorded as a liability, specifically under deferred revenue. But a couple of things are occurring here. First, Starbucks earns breakage revenue. This is revenue that Starbucks estimates will never be redeemed by the consumer. Starbucks collects the cash, it goes unused, and Starbucks keeps it as pure profit. For fiscal year 2023, this was $196.1 million. Secondly, this stored value is effectively cash in the bank, which means it can be deployed to earn a return. Warren Buffett and Berkshire Hathaway didn't build their massive fortune through compound returns alone. They had access to interest-free capital to do so. This was the float on their insurance premiums. For Starbucks, this stored value is the equivalent to the insurance float. But unlike insurance float, the risk that far more cash will be paid out to the insurance claims than what is on the books is nil. Starbucks will never pay out more in stored value than what it collects. In my view, Starbucks can deploy this stored value to interest-bearing investments and earn even more in pure profit. If they announce this next quarter, their share price would rocket up 20%. They are leaving value on the table by not doing this. Their most recent quarter, on March 31st, saw $1.8 billion of stored value on the books. Imagine an investment fund of $2 billion AUM to play with. The loyalty program itself incentivizes consumers to keep returning through gamification of sorts. Consumers earn stars, which go towards discounts or free drinks. Beside earning through purchases, they could earn through completing surveys and engaging with promotional content. It also allows Starbucks to offer personalized rewards for members. Starbucks built a loyal customer base with this program on top of their superior coffee shop experience. The question is, however, are these two competitive advantages still intact? Another push Starbucks has made the last few years is drive-through stores. Drive-through stores represent a vast majority of new locations, approximately 90%. These stores have less seating. They are catering to the grab-and-go cohort. Same with the mobile app. It de-emphasizes Starbucks as a place to go between work and home, the third place. Stores have less seating, and the seating that is there aren't comfy couches, but hard chairs. They drastically cut down the amount of merchandise and bags of beans for sale. COVID also altered how Starbucks positioned itself. Aside from closing 400 stores down, they transitioned their layouts from the coffeehouse concept to a convenience-led model, focusing on drive-through and curbside pickup. Separate counters for mobile orders have become the norm. Inflation has not only affected prices, but the loyalty stars as well. In February 2023, instead of spending 50 stars for a hot coffee, you need to spend 100. There have been a whole host of changes to the rewards program over the years, linked in the article below, that basically amounts to requiring more spend to earn stars, as well as free items costing more stars. Starbucks had a moat so strong that they enjoyed what other wide moat businesses enjoyed: pricing power. It's no secret that restaurants regularly increase prices. Starbucks has been steadily upping its prices for years. But have we finally reached the limit of these increases? In 2022, the average price of a tall latte in Illinois, my state, was $3.36. If I order one right now, it costs me a whopping $4.95. That's a 47% increase. My usual drink was a venti black coffee. I paid $3.63 in 2022. Today, it's $4.30, or an 18% increase. Specialty drinks routinely cost over $7 now. Starbucks consumers never seem fazed by these increases, but that seems to be changing in 2024. There is real pushback by consumers and has shown up in its earnings. I believe Starbucks has strayed from its core value proposition. Starbucks offered an experience, a relaxing third place away from home and work. They introduced espresso to the mainstream American consciousness. It offered tasty specialty drinks that were fun and habitually affordable. They rewarded their loyal customer base, and it never felt like a rushed experience. I remember feeling cozy in a Starbucks. Now I can't wait to get out of the place. It is sterile and unwelcoming. They cater more and more to the on-the-go customer, instead of trying to keep people in the store where they can spend more money. The staff is also stretched between making mobile orders and in-store orders and drive-through orders, increasing wait times for everyone. They also have a menu that tries to be all things to all people. Their core is no longer coffee drinks. There is no core. They are reacting to their competition. The drink market is saturated today, from health drinks to energy drinks to sugary caffeinated drinks. Instead of focusing on one core offering, Starbucks is trying to do it all. They are commoditizing themselves in the process. But what is Starbucks' valuation? Have they reached their peak for returns, or is there still growth left in this company? They have an ambitious plan to operate 55,000 stores by 2030, up from 38,000 stores at the end of fiscal year 2023. That will take significant capital, however, and Starbucks is already a capital-intensive business. They plan on spending $3 billion in capital expenditures in 2024, their highest amount ever. That CapEx is coming out of operating cash flow that is bolstered by fewer working capital needs rather than a boost in earnings. What is Starbucks' growth plan over the next few years? Let's take a look here. For their triple shot reinvention with 2 pumps plan, the first is elevate the brand through running better stores, growing the portfolio with more purpose-defined stores and accelerated renovations, and driving further product innovation. Their aim here is to get even more drive-through oriented or pickup oriented, on-the-go, consumer oriented stores. They also want to expand their portfolio of drinks to even more non-coffee related, non-specialty coffee, espresso related drinks. To me, it is moving away from that core, that Starbucks experience I talked about earlier. The more on-the-go consumer oriented their stores are, the more they're more like a McDonald's or a Dunkin' Donuts. Another thing to keep in mind, McDonald's faltered a little bit in the early 2000s, and McDonald's faltered because they kept expanding their menu, adding more and more items that weren't part of that core hamburger, cheeseburger offering that McDonald's became great on. They lost that focus of a few menu items, and I believe that's what Starbucks is doing as well. They keep expanding their drink selection instead of focusing on a few core beverages that made them great in the first place. We'll see how this plays out. That is just my speculation. Strengthen and scale digital by doubling its 75 million Starbucks Rewards members within 5 years and expanding digital and technology collaborations to elevate the partner and customer experience. While they do have an excellent loyalty program, it's very good to expand that loyal customer base, get more people on the app. It does help with the rewards that they offer. What we will want to watch out for there is, just like there's inflation within the prices of Starbucks, and we might be seeing that limit the consumer's willing to pay for those specialty drinks, will that inflation also affect their loyalty? If it keeps taking more stars to get that free beverage? Will that hurt their app as well? We'll see how that plays out. And the third one is become more global by accelerating store expansion to 55,000 globally by 2030. Now, to me, this is the best way Starbucks can grow. I believe right now that Starbucks is very saturated in the United States. Much like McDonald's, they've tapped out the market in the United States, but global expansion, there's a lot there. And as we've seen, they're losing their pricing power a little bit, so they have to expand through real physical growth, and that's adding more stores to the portfolio. But what we want to understand is how they're adding those stores to the portfolio. Are those stores going to be additive in terms of will they increase margins or will they decrease margins? Let's take a look. At the end of their fiscal year 2023, Starbucks operated 38,000 stores. There are two types of stores they operate: company-operated stores and licensed stores. Company-operated is exactly that. Starbucks itself owns and manages those stores. Licensed stores are franchises. That breakdown works out to 52% are company-operated and 48% are franchises. In terms of the breakdown between North America and international, remember, North America will include places like Mexico and Canada. There are 20,200 stores, both company and franchises, internationally. That is roughly 53% of Starbucks' store portfolio. So there's two things we have to think about here. What are the margins for the franchises versus the company-operated stores? What are the margins domestically versus internationally? Revenues from our licensed stores accounted for 13% of total net revenues in fiscal 2023. Licensed stores generally have a lower gross margin and a higher operating margin than company-operated stores. Under the franchise model, Starbucks receives a margin on branded products and supplies sold to the licensed store operator, along with a royalty on retail sales. Licensees are responsible for operating costs and capital investments, which more than offset the lower revenues we receive under the licensed store model. So essentially, they take a cut from what these licensed stores earn. They're not really responsible for costs, but given that they're essentially collecting a fee, it's still only a percentage of total sales that these stores earn versus all the sales like their company-operated stores are earning, and leaves a lot on the table there for Starbucks. I believe it's one reason why Starbucks really resisted the franchise model for years while they were aggressively expanding in the 90s. What's more interesting to me is the margins from North America versus international. You can see here, North America revenues were at $26.5 billion in 2023 and at $5.5 billion in operating income. That translated to a 20.7 operating margin for the North American segment. Internationally, however, they had $7.4 billion in total revenues and an operating income of $1.2 billion in fiscal year 2023. That operating margin, however, was 16.4%, 4% lower than what we're getting in North America. Where are their stores expanding to get to this 55,000 store number in 2030? They're expanding internationally. A lot of their expansion is occurring in China and other emerging markets. The company themselves have stated that. For that growth plan, they say that 3 out of every 4 new stores will be international. So it's very reasonable to assume that while yes, they will grow their revenues, that's not a question here with Starbucks. How are those margins going to grow? Margin growth helps drive value creation for investors. It's reasonable to assume because of their growth plans internationally, that margins will probably stay flat, maybe decline or increase just very slightly. But we're not going to see crazy margin expansion like we do in other growth businesses. There's another aspect of Starbucks' fundamentals that concerns me a little bit in terms of future growth. That is their long-term debt. Out of Starbucks' $15.3 billion in debt, 2/3 of that, over $9.8 billion, is due in 2029 or after. They have a long time that they have debt to repay. And even more concerning is, let's look at this effective interest rate. Debt that is due between 2024 2025, 2026, even through 2028, we see 3.7%, 4.7%, 2.5%, 2%, 3.5%. Let's look at the debt that's due later. The debt that's due in the 2040s, 4.3%, 3.7%, 4.5%, 4.4%. A much more elevated interest rate on those longer term notes. They're going to be paying a higher interest rate for a longer time. Their interest rate margin right now, defined as interest expense divided by their operating margin, is at 10%. I don't see that coming down anytime soon. They have a very large debt burden, and that's going to hurt their bottom line. So looking at a quick summary of some of Starbucks' fundamental growth here, you can see the revenue, gross profit, operating income. It has grown. Certainly not the growth of a tech company, but there's definitely growth there. We can see over the last 10 years, they've grown at nearly 10%. Their gross profit has grown 9%. Their operating income at almost 10% as well. So they've done a really good job of those income statement growth line items. They also have a very good dividend. As we can see here, dividend yield is at 3%, over 3%. So very solid dividend return. But what concerns me on this list here is this, their cash flow. They're not doing a good job of consistently compounding their operating cash and thus their free cash flow. And because they're such a capital intensive business due to store maintenance, opening new stores, whatnot, failing to compound that operating cash will hurt their free cash flow. And we can see how that has taken a little bit of effect. First off, their dividend has slowed down a little bit. We can see their dividend was at almost 11% growth 5 years ago, it's at 8% this past year. Now that's still very good dividend growth. It's outpacing inflation, depending on what number you use for inflation, but that's still good dividend growth. But it's also affected their shares outstanding, buybacks more specifically. They were buying back an average clip of 2.7% over 10 years. Last year, they bought back just over 0.5% of their shares. So they have to slow down that buyback program because they're not generating that compounding free cash flow. So as an investor, that's something that's concerning. Another thing to look at here is their margins. Their margins have come down a little bit. It's nothing crazy. Their average over the last 10 years at 28.4% for gross margins. Now it's at 27.5%. So it's not horrible decline in margins, but it's something to keep an eye on. However, one very positive thing about Starbucks, they do have a very solid return on invested capital and return on capital employed, about over 30% in the trailing 12 months here. So that's something working very much in their favor. And honestly, you can expect returns to kind of converge on the return on invested capital over the very long term. They do have to execute on some of these other areas though. But let's look at the dividend metrics here real quick. While they do pay a growing dividend, and due to their share price falling over the last few months and years, that yield has steadily increased. What really concerns me is that free cash flow payout ratio here. See, it's 47% 3 years ago, 66% in the last fiscal year. And you can see on this free cash flow versus dividends paid here, they're really struggling to generate the free cash flow necessary to pay that growing dividend. So we're going to have to see that real free cash flow growth in order for them to sustain their dividend growth at the rate that it has been at 8%. Will they be able to do that with the massive CapEx investment they're going to be making to open almost 20,000 new stores by 2030? These are the growth projections I have for my base case for Starbucks over the next 10 years. Revenue is at 5.7%, operating income at 5.5%, net income at 4.59%, earnings per share at 5.26%, and free cash flow growth at 5.8%. The revenue projections are based on analyst projections, as well as that lowered guidance Starbucks provided last quarter. I have the operating margin expanding to 15% by year 10, but actually that's really just flat operating margin growth. And that's due to the type of expansion I talked about earlier. They're going to be expanding much more internationally, which we know is a much lower margin expansion. Net margin, I actually have declining to 10.25%. A big part of that is that interest expense is really going to hurt their net income growth over the next 10 years. And free cash flow margin comes in at about 10.26% on my base case by year 10. For context, analysts are projecting at about a 14% free cash flow margin. I am using that number actually for my bull case, and I'll show you those assumptions here in a second. I do think a 5.8% free cash flow growth over the next 10 years is reasonable. It would be just under what their 10-year compound and average growth rate has been for free cash flow. For the dividend discount, I have a 5.9% 5-year compound annual expected growth rate for their dividend here. It's a 5% perpetual dividend growth rate thereafter. You can see that it's an expected free cash flow payout of about 67%. Currently, their expected free cash flow payout is at almost 80%. So it's unlikely to expect the same level of growth that we've been seeing historically. Here are my bear, base, and bull assumptions. So like I said, for the operating margin, I have it declining to about 14%, 15% for the base, and 16% for the bull. That interest expense margin of 11% for the bear case, 10% for the base, and at 9% for the bull. And my free cash flow conversion, 85 cents free cash flow conversion for my bear case, $1 for my base case, and $1.25 for the bull, which is in line with the analysts' expectations. And we can see that the base case would be 5 cents higher than what their trailing 12 is, and the bear case would be right around their 10-year average. So I think that bull case for $1.25 for free cash flow conversion is actually pretty optimistic. So it'll be interesting to see if they can hit that. Starbucks closed out the day today at $72.75. My DCF model has their bear price at $47.63. Their base case is at $70.57, and a bull case of $109.55. The dividend discount model, however, the bear case is at $66.27, $72.38 for the base case, and at $79.60 on a bull case. And their exit multiple is at $80.40. So we can see here, there's quite a bit of downside still on that bear case, about 16.8%, 1% upside on the bear case, and a pretty healthy 30% upside on the bull case. But that bull case is very optimistic. You can see that gives us a buy price of $75.55 without any margin of safety, which given today's price at $72.75 is in the buy range. That's a 22 forward PE. And we can see the PE is at 20 right now and at 21.2 on a forward basis, which is well below their 5 and 10-year averages. However, in the past 5 and 10 years, Starbucks enjoyed quite the competitive advantage. They had that pricing power, and they had the experience that no other restaurant could replicate. I believe that advantage is eroding, and they are trading now much more in line with a typical restaurant. However, on the quality investor, we always want to buy with a large margin of safety. With a 10 to 20% margin of safety, we're looking at a buy price of at $60.44, that 20% margin of safety, or a 17.6 PE. I think there's still a lot of room for Starbucks to come down. I don't think they're out of the weeds yet. They might have a few more troubling quarters in them. We shall see. And if they do, that price is still going to come down. They are a good dividend stock. But like I said, that dividend, that free cash flow payout ratio, is creeping up ever higher every year. So I think there's a lot of risk here right now with Starbucks. And even at $72.75, I still don't think it's worth it. I think it's a stock that we want to see them turn around quite a bit, solid earnings growth, getting back to that core Starbucks experience that they were famous for, and doing a better job of keeping customers in the store coming back throughout the day. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.